What if the single tax deduction you've been overlooking is quietly costing you tens of thousands of dollars every single year? We're not talking about some obscure loophole, we're talking about something hiding in plain sight, the kind of thing that makes accountants smirk when clients finally discover it. The deduction that changed everything for me was the home office deduction. And before you roll your eyes, hear me out. Because this isn't your grandmother's "I put a desk in my spare room" situation. This is a systematic, legally aggressive strategy that, when done right, cascades into one of the most powerful tax reduction tools available to anyone running a business or investing in real estate. Here's the thing, the IRS essentially built a back door into the tax code, and most people walk right past it like it has an out of order sign on it. The home office deduction lets you write off a percentage of your mortgage interest. Utilities, repairs, insurance, and even depreciation, all tied to the square footage you use exclusively for business. Let's say your home is 2,000 square feet and your dedicated office space is 200 square feet. That's 10% of every qualifying home expense now becoming a business deduction. Multiply that across a mortgage, utilities running $1,500 a month, and property taxes, and you're suddenly looking at deductions that dwarf what most people get from their standard write-offs. What's wild is that just a few years ago, this deduction was getting laughed out of audit rooms because people were claiming their living room couch as a client meeting space. The IRS cracked down hard and overcorrected public perception so severely that even legitimate claimants started running scared, which is exactly what the tax code quietly benefits from: your fear and your ignorance. Here's where the psychology gets interesting. People chronically underestimate what they're entitled to because the tax code feels like a language designed specifically to humiliate them. But the home office deduction isn't complicated. It just requires two things: exclusive use and regular use. And if you can document those two words, you're in the game. Historically, self-employed individuals and real estate investors who consistently claim this deduction reduce their effective tax rates by anywhere from 2 to 5 percentage points annually, and compounded over a decade. That's not a rounding error. That's a down payment on another property. The pattern is clear. The people who treat their tax strategy like an investment strategy win quietly, while everyone else argues about which streaming service to cancel. Now let's kill the biggest misconception right here, claiming a home office does not automatically trigger an audit, and that myth has been financially damaging more people than any actual audit ever could. The IRS targets deductions that are disproportionate to income, not deductions that are legitimate and well documented. The practical lesson is almost embarrassingly simple. Measure your dedicated space, photograph it, document your usage, and work with a CPA who understands small business and real estate tax law. Discipline here isn't glamorous. It's spreadsheets and receipts and a folder that lives on your desktop labeled "Do Not Ignore." What makes this deduction particularly powerful for real estate investors is that it stacks your deducting home office expenses on top of depreciation, travel, education, and entity-level write-offs, building a tax reduction architecture that compounds year over year. It's less like finding a coupon and more like discovering your grocery store has been quietly overcharging you for a decade and now owes you a refund. The irony that almost nobody talks about is that the wealthiest investors in this country use the most boring, consistent, and methodical deductions, not exotic shelters, not offshore accounts, just relentless documentation and professional guidance. The edge isn't secret knowledge. The edge is execution, that 90% of people are too impatient or too intimidated to follow through on. So the philosophical takeaway here is this. It was never about finding the one magical deduction. It was about building a system where every legitimate deduction is captured every year without emotion or procrastination. Consistency in tax strategy, like consistency in investing, is where the real compounding happens. And that's a truth that doesn't care about your income level or your portfolio size. If you're ready to stop leaving money on the table and start building that system, whether that's through real estate investing, home contracting, work, or connecting with lenders who understand your goals, check out our links in the description below and let's get you started.